In 1929, U.S. stocks had climbed for 8 straight years. Corporate profits were strong, unemployment was low, and credit was cheap. Newspapers called it a permanent era of prosperity. Then, within months, the Dow Jones lost 89% of its value and the global economy collapsed. A century later, the data rhymes. Corporate profits are again near record highs, unemployment again near historic lows, and household debt again at its peak. Investors believe the Federal Reserve can always step in to save the market. That confidence, the same that defined 1929, may be the most dangerous signal of all. The question is not whether a recession is coming. It's how deep it goes when credit, consumption, and confidence break together. Economists often say that history doesn't repeat, it rhymes. To understand 2026, we have to study 1929, not as nostalgia, but as a data pattern. In the 1920s, U.S. debt grew faster than income for 8 consecutive years. Banks issued margin loans that allowed investors to buy stocks with 10% down and 90% borrowed money. By September 1929, those margin loans equaled 12% of GDP, a record then. In 2025, total U.S. margin debt surpassed $1 trillion, roughly 3.5% of GDP. That's lower as a ratio, but in absolute terms, larger than ever recorded. Household debt is $17 trillion, federal debt exceeds $35 trillion, and corporate debt has doubled since 2008. The same symmetry exists: credit expansion built on confidence that the cycle cannot break. In the late 1920s, the Federal Reserve raised rates to cool speculation, from 3.5% in 1927 to 6% by 1929. The timing was crucial. Credit was tightened just as leveraged investors needed liquidity. When borrowing costs rose, forced selling followed. Today, the Fed is repeating that pattern from another angle. After a decade of zero rates and massive stimulus, the pivot to 5% policy rates is the steepest since the 1980s. Corporate interest expenses are up 70% year over year. Households are spending more on debt service than any time since 2007. Economic slowdowns don't begin when rates rise. They begin when the cost of past debt meets present income. That collision is scheduled for 2026, when trillions in corporate and real estate loans must refinance. Every major recession shares 3 triggers: overvaluation, overconfidence, and overleverage. In 1929, price-to-earnings ratios averaged 32 on the Dow. In 2025, the S&P 500 sits above 25, higher than any pre-2000 period except the dot-com peak. Meanwhile, corporate profits are slowing and earnings growth is flattening, even as valuations rise. That divergence, rising prices without rising profits, is what preceded both the 1929 and 2000 crashes. Yet investor sentiment remains unshaken. The belief in a soft landing has become consensus. In market history, consensus has rarely been a safe position. To see why this cycle feels stable but isn't, look at the labor market. Unemployment below 4% feels healthy, but in real terms, job growth is concentrated in low-wage sectors and public employment. Full-time private sector jobs are shrinking in manufacturing, retail, and technology. The illusion of strength comes from numbers that hide quality behind quantity. In 1929, it was similar. Employment was high, but wages were stagnant, and productivity growth was declining. Prosperity looked statistical, not sustainable. Credit conditions tell the rest of the story. During the Roaring '20s, total private credit grew faster than GDP for nearly a decade. When it contracted, so did everything else. Today, the same relationship exists through modern mechanisms: consumer credit cards, auto loans, and corporate bond markets. The average American household owes $7,000 on credit cards with rates above 22%. Corporate junk bond yields have doubled since 2021, and as refinancing windows close, defaults are rising in both consumer and corporate segments. A credit system that was built for 0 rates is now being tested at 5. The math no longer works for the marginal borrower. In 1929, that borrower was the retail stock speculator. In 2026, it may be the mid-sized company rolling its debt at twice the rate. Monetary policy lags by roughly 18 months. Rate hikes from 2024 will hit their full economic impact by late 2025 to mid-2026. That means the recession, if one develops, is already baked into the data. Indicators support the timing. The yield curve, the gap between 10-year and 3-month Treasury yields, has been inverted for over 500 days, the longest stretch since the 1960s. Every U.S. recession in the past 70 years was preceded by that signal. Corporate profits as a share of GDP are declining. Real wages are falling after inflation, and the consumer savings rate is near record lows. These aren't forecasts. They're conditions that already exist. Market psychology is the bridge between data and disaster. In 1929, it was the belief that a new industrial age had made recessions obsolete. In 2025, it's the belief that the Fed has made crashes impossible. When investors trust policy more than profits, they trade narratives instead of numbers. That trust works until the first policy failure. History suggests it will be a shock, not from inside Wall Street, but outside it. A geopolitical conflict, a credit event in private markets, or a currency disruption. In 1929, it was a liquidity squeeze that started the cascade. Banks tightened margin loans. Investors sold to meet calls. Selling became panic. In modern terms, that would look like corporate bond fund outflows, a sharp spike in credit spreads, and forced selling by leveraged ETFs. Technology changes, but leverage behaves the same. Another parallel lies in wealth distribution. In 1929, the top 10% of households controlled about 45% of income. Today, they control nearly 50%. Inequality isn't just a moral debate, it's a macroeconomic variable. When most wealth is held by few, aggregate demand weakens because the marginal propensity to spend drops. That makes the economy more sensitive to asset price shocks. When stocks fall, the wealth effect collapses, and consumption contracts faster. Policymakers are not blind to these signals. The Federal Reserve and Treasury both track recession probability models that currently show risk above 60% within 12 months. Still, the official messaging remains optimistic. Soft landing, controlled slowdown, transitory disinflation. It is the same language used in 1929 when the Fed called market turbulence a healthy correction. Confidence maintenance is a policy tool, so is denial. But data doesn't negotiate. Credit default swaps on U.S. sovereign debt hit multi-year highs in 2025. Corporate defaults have risen for 5 straight quarters. Commercial real estate valuations continue to fall. The numbers are aligning the way they did before previous downturns, slowly, quietly, and mathematically. If the cycle unfolds as data suggests, the timeline is predictable. First, credit tightens, then investment slows, employment follows, and finally, consumption contracts. By the time the official recession is declared, it will already be 6 months old. What makes 2026 unique is not its probability of recession, but its potential depth if policy response is delayed. Government deficits are already above 6% of GDP. Stimulus room is narrow. Interest payments on federal debt now exceed defense spending. That limits fiscal firepower. Monetary stimulus faces inflation constraints. Unlike 2008, there is no easy button left. The comparison to 1929 isn't prophecy, it's probability. The parallels in credit growth valuation and sentiment don't guarantee collapse. They map risk. What history teaches is not that crises repeat, but that humans do. When every indicator flashes the same pattern and confidence remains high, the end tends to surprise only those who weren't looking. By 2026, the data may not say another 1929, but it will rhythm the same song: debt, denial, and delay. And, as always, the recession will arrive not as a headline, but as a statistic already printed in the past. When the crash began in 1929, it wasn't called a crash. Newspapers described it as a technical correction, a short panic inside an otherwise booming economy. Investors bought every dip, convinced that industry would outgrow its tremors. But within months, unemployment tripled and industrial output fell by half. What began as noise became catastrophe. That's the danger of delayed recognition. Recessions rarely start with panic. They start when logic no longer fits reality. By the time data confirms it, confidence is already gone. The first phase is always liquidity. In 1929, credit to brokers evaporated. Today, it would begin in short-term funding markets. The invisible pipelines moving trillions overnight. When liquidity dries up, prices don't drift lower, they gap violently. Rational investors learn they can't all exit at once. Modern markets are faster, but not safer. Over 70% of daily volume comes from algorithms trading momentum, not fundamentals. In stress, machines amplify fear. A 2% slide becomes 5, 5 becomes 10. In 1929, it was panic in the pit. In 2026, it will be code executing logic with no emotion. Then comes credit deterioration. In 1929, the contagion spread through banks. In 2026, it will move through shadow finance, private credit funds, REITs, and collateralized loans. These funds now hold nearly $2 trillion in corporate debt, most lent at floating rates during the zero-rate era. Each month of high rates shifts billions from borrowers to lenders until defaults begin. Default rates in leveraged loans are already above 5%, expected to hit 8% by mid-2026, the same level seen before the 2001 slowdown. Corporate earnings still look solid, but margins are shrinking. Profits are being protected through layoffs, reduced hours, and deferred investments. That isn't resilience, it's retreat. Consumers have been the last line of optimism. Restaurants are busy, travel strong, and spending steady. But debt, not income, is keeping the illusion alive. Credit card balances are near record highs, delinquencies up 50% among younger borrowers, and savings nearly exhausted. This pattern is familiar. In 1929, Americans financed prosperity through installment credit right before the collapse. Confidence, once again, replaces caution. In the late 1920s, people believed industry had tamed risk. In 2025, they believe the Federal Reserve has. Every generation convinces itself the system has evolved beyond error until it doesn't. Employment is the next phase. Labor markets lag because businesses hesitate to cut staff until margins vanish. By the time layoffs hit headlines, the recession is old news. The modern warning signal isn't unemployment, it's job openings. The U.S. JOLTS data shows openings down 25% since 2022, mirroring the same slide seen 1 year before the 2008 crash. Tech and logistics are already contracting. The numbers hide a deeper weakness. More people are juggling multiple part-time jobs. Wage growth has flattened in real terms. It's statistical strength, not economic health. When job quantity masks declining quality, recessions form beneath the surface. Asset repricing follows employment. Stocks fall first, real estate second. In 1929, homes didn't crash instantly. They drifted lower for years as credit evaporated. The same pattern is visible now. Housing affordability is at a 40-year low, mortgage rates above 7%, and transactions down over 30%. A frozen market looks stable until you notice that nothing's selling. Commercial real estate is the deeper fault line. Office towers are half empty, retail continues to erode, and loans are maturing fast. A 10% drop in valuation across this $20 trillion sector equals $2 trillion in paper losses, enough to squeeze banks and pensions. The damage is slow, not dramatic. It's erosion, not explosion. The next stress point is fiscal. In 1929, Washington had little debt and room to spend. By 2026, the U.S. enters crisis with trillion-dollar deficits and record interest costs. Interest payments now exceed defense spending. Fiscal stimulus becomes an expensive promise. The government can't print credibility. That constraint forces new tactics. Instead of broad stimulus, policymakers use guarantees, swaps, and backstops, soft tools that buy time but not growth. Economists call it a contained recession. No crash, but no recovery either. Japan, after 1990, lived that reality. High debt, low growth, and decades of stagnation. The U.S. risks the same if it confuses delay with solution. Market mechanics now magnify every swing. Passive investing dominates. Index funds own more than half of U.S. equities. When investors pull money, funds sell everything in proportion. The good, the bad, and the overvalued alike. Price no longer reflects merit, only flow. Derivatives add fuel. Options trading now exceeds stock trading. Retail traders speculate daily through short-term options that force automatic hedging by market makers. The result? Amplified volatility. When markets fall, machines sell first. Humans react later. At that point, the Federal Reserve becomes the only stabilizer and the biggest risk. It faces a trap with no clean exit. Cut rates and risk inflation, or stay firm and risk defaults. Either path costs credibility. In 1931, the Fed raised rates to defend the dollar, deepening the depression. In 2026, the mistake could be the opposite, easing too soon and reigniting price shocks. The institution once seen as omnipotent could confront its limits in real time. Meanwhile, the world economy slows together. Europe fights energy shocks, China battles deflation, and emerging markets choke on dollar debt. Global growth is near its weakest since 2009. If fear pushes investors toward U.S. Treasuries, yields may drop. But if confidence cracks, they could spike instead. It's a paradox the Fed can't control. The dollar remains dominant but not untouchable. Its share of global reserves has slipped from 72% in 2000 to about 58%. The erosion is gradual, yet constant. If fiscal credibility wavers, de-dollarization will quicken. History repeats, not through conquest, but through math. By late 2025, the warning lights will be visible. Defaults up, spreads wide, volatility returning, hiring frozen. The system will still appear stable, right until confidence folds. Maybe it's a large fund failure, maybe a geopolitical shock. Either way, the calm will feel normal until it isn't. The real recession doesn't begin with numbers. It begins when trust breaks. In 1929, people stopped believing in stocks. In 2008, they stopped believing in banks. In 2026, they might stop believing in policy itself. By mid-2026, denial will fade, replaced by reluctant realism. Markets will stabilize lower, credit will tighten, and patience will become strategy again. Recession isn't disaster, it's correction. What matters is how deep the correction runs and whether the lessons are remembered this time. When historians look back, they'll argue whether 2026 was a collapse or a correction. In truth, it will be both, a collapse of confidence and a correction of excess. Every financial reckoning begins with the same illusion, that the system can defy its own math. The Great Depression wasn't inevitable in 1929. It became inevitable in 1930, when leaders mistook liquidity for solvency and optimism for stability. They waited for recovery that never came until the structure itself gave way. The same risk exists now. The longer faith substitutes for reform, the harder the landing becomes. The recovery from that era teaches the real lesson. The U.S. economy began stabilizing within 3 years, but policy errors turned recession into depression. And when stimulus came late or austerity too soon, the damage multiplied. In 2026, that lesson is critical. Confidence is not policy, and timing is everything. Unlike 1929, modern policymakers have tools: stimulus, credit windows, balance sheet expansion. But tools are not solutions. They are bets on psychology. If the public sees rescue efforts as inflationary, they lose trust in money itself. If the government hesitates, unemployment soars. Each path carries pain. Choosing is not optional. The U.S. will face a double recession, one of balance sheets and one of belief. Corporations will deleverage instead of investing. Consumers will save rather than spend. Governments, politically divided and fiscally strained, will argue over how much relief is too much. Growth will slow even as optimism fades. Japan's 1990s stagnation offers a modern mirror. After its property bubble burst, Japan didn't collapse. It drifted. The economy survived but never fully recovered because fear replaced ambition. That's the risk for America if it treats 2026 as a pause instead of a reset. The only way out is through recognition. Write down bad debt. Let weak firms fail. Restore trust by facing losses early. That's what worked after 2008. Recapitalize, reset, rebuild. The faster the cleanup, the shorter the slump. The scale of debt defines the stakes. Households owe nearly 100% of disposable income, corporations about half of GDP, and public debt over 120%. Debt itself isn't fatal. Denial is. Each dollar of intervention adds to the next crisis's cost. The system can handle leverage. It can't handle lies. Inflation and interest rates are no longer technical levers. They're mirrors of trust. Low inflation assumes debt will be repaid. Low rates assume borrowers will grow. If confidence breaks, both assumptions collapse. That's what happened in the 1970s, and again in 2008. Different causes, same consequence, lost faith. The pivotal question for 2026 will be faith in the Federal Reserve. Since 2008, markets have learned one reflex: buy the pivot. Every dovish turn triggered rallies, embedding the belief that central banks can always rescue risk. But monetary credibility isn't infinite. If inflation rises while growth contracts, the Fed faces a trap: ease and lose credibility, or tighten and deepen pain. That's the same dilemma that broke 1931's policymakers: defending currency or defending people. History will judge today, S-choice the same way, whether control was preserved at the cost of confidence. Globally, fragmentation adds pressure. The 1930s depression deepened because countries turned inward. In the 2020s, deglobalization and supply reshoring echo that retreat. Each region now builds its own walls: economic, digital, and political. That shift reduces fragility, but also limits growth. If the 2026 slowdown accelerates this trend, world trade could stagnate for years. The dollar remains the system's backbone and its vulnerability. During crisis, it strengthens as capital flees risk, cooling inflation but hurting exports. When recovery begins, it weakens, importing inflation back in. Managing that loop requires coordination between Congress and the Fed, a task modern politics rarely achieves. The cultural aftershock may last longer than the downturn. Just as the 1930s created a generation that valued thrift and regulation, the 2020s may forge one that prizes stability over speculation. Younger Americans, raised through endless crises, may become the most conservative investors in decades. That shift could slow growth, but restore balance. Fewer bubbles, steadier foundations. Technology will reshape the rebound. Automation, AI, and clean energy don't vanish in recessions. They accelerate. Historically, downturns clear inefficiency, allowing innovation to flourish. Yet progress creates tension. Machines replace jobs faster than new ones appear. The next policy frontier won't be stimulus, it will be adaptation. By 2028, the rebuilding will begin quietly. Unemployment will ease, defaults will plateau, and markets will reset on rational valuations. Stocks will rise again, not on hope, but on math. Bond yields will stabilize, inflation will cool, and investors will rediscover long-term thinking. Recovery rewards patience more than prediction. The legacy of 2026 depends on memory. To some, it will mark the end of the cheap money era that began in 2008. To others, it will be the start of a more honest economy. Slower, leaner, but real. The financial system won't die. It will evolve as it always does. Every century has one defining reckoning. For the 19th, it was 1873. For the 20th, 1929. For this one, it may be 2026. Not because it ends prosperity, but because it forces renewal. The U.S. economy will emerge changed, less speculative, more disciplined, and less tolerant of illusion. Out of 1930s chaos came the social safety net, modern regulation, and the middle class. Out of 2026 may come fiscal discipline, digital finance, and energy transformation. Collapse and rebirth have always shared the same timeline. The next decade could resemble the 1940s. Recovery through reinvestment. Infrastructure, technology, and innovation replacing consumption as the growth engine. If that shift takes hold, 2026 won't be remembered as an end, but as a correction to reality. For investors, the takeaway remains timeless. Volatility isn't the enemy, blindness is. Diversify, stay liquid, and wait. In 1929, those who kept cash survived. In 2026, those who keep perspective will thrive. Markets heal faster than trust, and trust heals faster than memory. When once fear fades, opportunity returns quietly, and the assets nobody wanted when panic ruled. Arithmetic still rules the game. Leverage multiplies both gain and ruin. The difference is, who remembers that before the next cycle begins? By the time the decade closes, historians will see 2026 not as the fall of capitalism, but as its recalibration. A reminder that growth without discipline ends in crisis, and discipline without growth ends in stagnation. Balance is the invisible key to survival. The next 1929 isn't a date, it's a mindset. It happens whenever confidence replaces caution and history fades from memory. Whether 2026 repeats that pattern depends not on markets, but on us, because the data never lies. We just stop listening.